Welcome to Subramani. These are some of the things that I've learned by investing and by reading good authors like Morgan's Housel and good websites like Motley Fool, right? I mean, I could do a whole session on the books that I've read or reading or the websites that I follow. So some of the things, some of these learnings I'm going to talk about today is, first of all, whenever somebody tells you invest like Warren Buffett, they're joking, right? We do not have the strength of a Warren Buffett. We do not have the information of a Warren Buffett. We do not have the maturity and the patience of a Warren Buffett. So Warren Buffett may be 90, but he still invests for the next 50 years, 70 years kind of. He is not taking a 10-year view on the markets, right? And I think also that Warren Buffett was very made all his money in a very, very great time when America dominated the world and they could choose from which raw material should be sourced at what price and sold in which market at what price. That kind of track record companies also will not create, nor will anybody come and touch Buffett's 50-year investing track record. But remember, last 20 years he has underperformed the index. He's perhaps even underperformed gold for very long periods of time. But people will keep telling you, invest like Warren Buffett. Believe it's not possible. There are many things which Buffett says which look very correct and very intelligent, but it is not very easy to do. Be greedy when others are fearful and be fearful when others are greedy. By the time you are in the market, you do not even realize whether you are fearful or whether you are being greedy. Please understand, even if somebody tells you that I don't want to sell now because I think the market will go up, is he being greedy or is he being fearful of loss of profit, right? So it's very difficult to say what is greedy, what is fearful, and how one should act. One will act like how we act in a herd, right? That is exactly how animals behave, and that is how we will behave. Reading books on behavioral finance is useful to see the mistakes that you are making, and we all make many mistakes, and make sure that we correct it next time or reduce its impact dramatically. That is what you can do. So all this greed, fear is fine. You will also have regret. Then if you have to report to a board or if you are managing somebody else's money, you will also have to tell that person why you did certain things. So it's not easy. For example, in 1986, if you had bought Coromandel International, it is given 230 times. It is a 230 bagger as of today. But remember, 230 bagger may sound very impressive, but it is also over 34 years. And apart from this, it has given dividends, right? So that kind of a return requires a lot of patience, and you could have gone completely wrong. You could have bought a share which would have gone down. Everything could have happened. So please understand, this is again the myth of investing, saying long-term investment always pays. Of course it pays, but long-term investment looks like it pays because you have something called survivor bias. You are not looking at all the companies listed in 1986 and finding what returns they have got. On an average, it will definitely not be 230 times, right? So learn to analyze data. That's also important. Also, the difference between a great company and a company which makes money for you, the gap could be huge, right? It could be a great company. Larsen & Toubro could be a great company, but over 5 years it would have given minus 1% return or minus 2% return. But if there is an infrastructure boom, it will give you 82% return in next 3 months. So all these things can happen in the market. So please understand, just because the company is a good company or a very good company, it does not mean you can buy at any price and you will always make money. You will make some money. You may not lose capital. Those are very significant things, but you may make a pathetic return over a longish period if you got the cycle wrong, or if you bought it at a very high PE. So buying at a lower PE or not buying at a higher PE, forget buying at a lower PE, not buying at a higher PE is a very sensible defensive stance to take, simply because if things go wrong, if the valuation goes wrong, you take a huge hit, right? So be careful about that. Markets will always go up in the long run, but they will always have a pullback every year, at least to the extent what I have noticed is 10-12%, and once in a decade or maybe once in 7-8 years it will have a huge pullback of something like 30%, 35%, like what happened in March 2020. Be ready for it. In March 2020 I had money, so I could buy shares. That is a time when you buy, because you know this will happen. And I liked in the sense that if you take a calendar or you take a decade, and that is how we are going to assess, it happened perfectly in 2020. It was a 2010 to 2020 cycle. So 2021 to 2030. Again, there can be 130% drop and annually a 10% fluctuation, which means in a year which you get say 12% return, it is possible that the market is in some months was at -10, then it recovered the 10 and then gave you 12. That is what happened. That is the full journey. But what you look at is say, oh, 12%, I got a good return. Yes, but what was your mental state when it was -10%? That is what you have to ask, and be ready for it. I'm not saying you have to do anything, but be ready for it in the sense that at least do not sell. If you buy, great. If you don't buy, at least do not sell. There's another source of information if you want is let's say books, accounts of companies, or rather let me start with this: accounts of companies, books, media channels, YouTube channels, and of course blogs. So let us say you get your data from all this. Please remember, there's absolutely no accountability for almost any of them. The books of accounts of a company are actually audited, so that is the most trustworthy. In any other place, anything can be written, anything can be said by a set of people who are not being accountable, who come every day and they say what will happen, and the next day they say why it didn't happen. They have perfectly good, perfect sounding answers. Answers sound impressive, that is also true, but you don't need impressive answers. What you need is how to make money in the market. And that you're better off reading old books, new books. But remember, books are most books which you get to lay your hands on about equity have been written by American authors during a time when America dominated the world. So be careful about that also. And in the financial pundit area, there is no accountability. You cannot come tomorrow and say, Subra, but you said in this fund you will get 18%. If I said it, it is stupid of me to say it and super stupid of you to believe it. I normally don't say any such statements, but in case I've said, go Control or delete in your head. I may not delete the video, but please delete it from your head, right? Not making mistakes is largely enough to succeed at almost every level of the game. Suppose you're playing cricket. Look at Rahul Dravid versus the others. Rahul Dravid could just stay there and pat ball after ball. He is got the world record for facing the maximum number of balls, right? So being able to stand there and hit every ball or defend every ball and knowing which balls outside the off stump need not be touched, that is an amazing skill. Ditto for investing. You are standing there and continuously balls will be bowled to you. OFS, IPO, you must buy this today. Chemicals are doing well. America, China is shutting down chemicals. You don't have to do anything. Just stay there. Hit only the balls that you want to. Don't touch an IPO. Absolutely no need to touch an IPO. If the way you are making money is by doing SIP in mutual funds, continue that. No need at all to change your strategy, right? And even so-called legendary portfolios, if you see, you would have got fantastic returns from a few companies and in a few years. That's it. But the power of compounding makes this portfolio look great. So big, large wealth is very rarely because of R. I'm not saying it is not because of R, but largely it is the power of N, right? N is touted as an investment skill. It is just that it started early. Thank you.